Good evening, everybody who's been kind enough to dial in to join us for one of our expert speak sessions at Scripbox. These are a series of webinars where we are running to just for our clients and others to understand what we do at Scripbox, listen to some experts about investing, and just share their knowledge. I hope you enjoyed today's session. If there's one person who you would truly call an expert, and the word expert speak most of, is Vetri Subramaniam. It's been my pleasure and privilege to know him for many years. He was a senior on campus, even then rated as the most intelligent person on campus in the batch, and he's really proved that. He's just been a phenomenally successful and long-standing participant and investor in the Indian capital markets. Recently did a very successful IPO at UTI AMC. And if you are investing, you would probably know him and know him well. As somebody once said, I think that this book is available at all leading bookstores. And if it's not available, it's not a leading bookstore. Similarly, if you don't know Vetri, you don't know capital markets. Today's intent is to share Vetri's insights and his philosophy around investing, and more specifically around value investing. What is value? What is value investing? What is a value trap? And what is value and what value is not? So hopefully all of our listeners will get a better sense of best practices in investment and pitfalls to watch out for. But while we say that, we'd also like to assure our customers, the intent of these sessions is also to assure you that there is a lot of science, a lot of math, a lot of expertise which goes into investment. And it is always best to trust the experts. While you should try DIY in many things in life, investing is probably not one we'd highly recommend. Without further much ado, I'll hand over to Vetri. Vetri, welcome to this webinar, and thank you once again for taking time out after your very busy schedule, and even now with your sort of all the work that you have on your plate. Welcome to Scriptbox's Expert Speak webinar.
Sure, thank you. Thank you so much, Atul. Thanks for having me here on your platform. From my perspective, it's a delight to be here, simply because I know so many of you at Scriptbox and the larger team. So it's just wonderful to be here. I know this journey started a long time back, and I've tracked the progress over time. And I'm sure you've onboarded a large number of customers into the equity markets, and I think that's just a wonderful thing. Obviously, I think Atul's introduction was a little more generous than it should have been when it comes to things like intelligence. But it's also a good, point for me to sort of kick off here, which is to say, and it's not just me saying this, this is actually the guru, so to speak, Mr. Warren Buffett, who said it once, that when it comes to investing, and this is completely true, I can swear by it after having been in this profession for now 28 years, it's not really the IQ that matters. It's really the EQ which matters, which is the emotional quotient. Of course, investing, there is science, there is art, and there is that entire thing of managing your emotions. And, so it's really a very interesting domain in which to sort of test yourself. I now swear by that whole idea, which we sort of thought about back in our college days, about find a job you love and you'll never have to work a single day of your life. I actually feel like that because I feel like I've walked into a puzzle shop every single day. So it's a delight piecing together stuff. And yes, you've got to keep that patience. You've got to keep that emotional quotient there. So I think you made all the relevant points about what we are going to talk today. It's essentially about what I think is value investing. It's a term which means different things to different people. But I thought it was a good opportunity for me to give people a perspective on what we think it really means. And I particularly say this in the context of the fact that when you look around and you read press, you will hear a lot about things about how, buying value has not worked as an investment strategy. And I would actually submit that a lot of the outcomes that we've had in investing, which are fairly strong outcomes, are a result of that value investing concept. So I thought it was a good sort of opportunity to share what we mean when we use the word value and how we actually use that as an investment strategy. And then also talk about how, an investment firm like UTI really operates in terms of how we manage investments. What are the processes? What are the frameworks? What is the science that we bring to investing? And there's a little bit of art always, and that art is in the hands of the many talented people that I have in my team. And each of them is great in their own way. The stronger the team, the more diverse the team, the stronger the outcomes we experience. And I always say I'm as good as the team that actually works with me. And I'm delighted to have a fantastic team at UTI. So let me just dive straight in. What I'll do is I'll just
Just as a quick question, as before we get into the actual presentation, maybe it's worth a couple of minutes of sort of comparing an investment style of value investing versus technical versus, I mean, the various broad themes, so people just get a quick sense of why we ourselves are big believers in value investing, and philosophically, how does it sort of stand out, or how does it compare to other styles? And none of them are bad or good. I mean, everybody has his own preferences. But just a quick couple of minutes on the various buckets would really help as a knowledge for our
sure.
audience.
No, I think that's a fabulous question, and I'm glad you asked me this question. This is my belief, and there is no right or wrong in investing. What there is a disciplined approach to practicing a certain set of methods that you think work for you, and then being patient while waiting for the fruits to arrive, and at the same time realizing there will be seasons in which your approach will not work. But that doesn't matter. What is important is to stay the course, because your season will come, and when it comes is your time to sort of score the boundaries and make up for the lean patch that may have been there earlier. And the way I've described this to people, though they sometimes laugh at me, is that a lot of these theories of investing are like religious dogma, right? But eventually, all religious dogma tells you the same thing: practice my faith, and eventually you will find happiness and you will get to heaven. But you can't run one day to the temple, next day to the mosque, next day to the church, and the next day to the synagogue, and then keep repeating this every day, and then say, look, I'm not getting where I want to. So, to my mind, it's the same thing. Pick the approach that works for you, the approach that intellectually works for you, the approach that works with your EQ, and then stay with it. Uh, to give you a very quick snapshot, I think of growth investing as a sort of theory of investing in which you invest predominantly looking at what could happen to the future of that particular company, its opportunity to grow, the opportunity to create value, and therefore it has a completely forward looking approach. The way we look at value investing is that value investing, of course, it also thinks about the future, but it is always testing that premise on the basis of what does the past tell us about this company? What can we learn about the past? Most importantly, where it diverges from growth investing is the sense that in value investing, we are always looking to buy things for slightly less than they are worth. And therefore, that what we call as margin of safety to our mind is an important part of our investing. Whereas in growth investing, it's really about backing the companies with the brightest future and not being so concerned about the actual price that you pay for it or the valuations that you pay for it. So I would say that's the integral difference between these two. Uh, just a moment on what you said, technical analysis and that approach to investing. I'm a little different from other fund managers because I started my career doing what we call prop trading. You literally buy in the morning, you sell in the evening, or you buy today, you sell tomorrow. If you're going to do that, then I have nothing against trading with technical analysis. It is a method, but it is a method which has a very short time frame in its thought process. Therefore, it's very intense. It taxes you mentally a lot more. it is not. It doesn't allow you to be patient because you're dealing with such short time frames. So it's not for everybody. But does it have uses? Of course it does. But for most of us, where we are thinking about our investing journey, which is 10 years, 20 years, and 30 years, do you really want to think about that as a series of sprints that you run every day? Or will you run it at a more leisurely pace over the course of that 10 years and 20 years? And that is where I think growth and value investing and few others in between blended approaches have a longer time shelf life, whereas the technical analysis approach is way too short term for my liking. And certainly, as a fund manager working for investors with a long term perspective, we tend not to use it. But if I was running a prop desk, honestly, I think that's a set of tools which are far more appropriate where I'm trading day in and day out as compared to the mutual fund environment.
Thank you so much. I mean, that is so valuable to us and to our customers, right? Because people get confused by these daily tips. And I think some of these pink sheets are very guilty of giving you 70% growth in this one stock. And I think this running at a pace which is acceptable to you for the long term is what Scriptbox is about. And I won't recommend that. We've been around for 8 years and we plan to be around for the next 80. And we want our customers to be for the next 80 with us. So over to you to talk about value investing, Vetri. Thank you.
Sure. Okay, just bear with me a minute and we'll get this going. Okay, great. I hope we've got that now up on the screen.
Yes.
So I titled this very simply as to what is value rather than what is value investing, because I think there's so much confusion about what that word itself means. So let's quickly dive into what that word means and why I think definitions of that have become rather problematic in recent times. I think when you talk to most people about value, unfortunately, it has come to denote merely cheap valuations. So people think that something is cheap very simplistically because it has what we would call a low price to earnings multiple or a low price to book multiple. That is what has come to be the very sort of popular definition of what is value. I think that is rather unfortunate. It's unfortunate because if you go back to what the masters like even Benjamin Graham or Warren Buffett really said, they really talked about this concept of intrinsic value. Intrinsic value is a very simple concept. Some of you would have encountered it in your college days. It's nothing but the value of the cash that a business earns during the remaining of its lifetime, except that it is discounted, which is to say the 10 rupees of cash you earn today is worth more than the 10 rupees you earn next year. And that is turn is worth more than the 10 rupees that you would earn 10 years from today. So essentially, we think of intrinsic value not as meaning low or rather value as not meaning cheap valuations, price to earnings, price to book, which are shorthand, but we think of value as meaning intrinsic value, which is the value of the cash can be taken out of the business during the remaining period of its life. And each of those words is important. The cash that can be taken out of the business, that can be taken out of the business during its remaining life. And in the course of this discussion, we'll see how each of these phrases is very, very important. Now, those of you who have heard of the concept discounted cash flow, or you may have heard of the term net present value, sort of mean the same thing. Warren Buffett's longtime partner quipped in response to Warren Buffett's statement that Warren talks about it, but I've never seen him do it. And in a lighter vein, that is true. It's a very challenging, calculation to carry out, but doesn't mean it can't be done. You just have to be wary about the many assumptions that go into it. But therefore, when we say value, we really think of intrinsic value and not really just cheap valuations. So let's think about, in the context of that same, in the background, think about intrinsic value. Intrinsic value, value of the cash which is earned by the company over its lifetime. Then think about value as meaning cheap valuations. What do cheap valuations not tell you? These are some of the things that they don't tell you. And over the next few slides, I'm going to show you how each of these actually have a very different implication for a set of companies. And we'll see how those metrics add up. So let's think about this. The first is EBITDA to OCF conversion. Now, I know that's a lot of acronyms there, but EBITDA is nothing but earnings before interest, tax, and depreciation. OCF is operating cash flow. Now, the reality is when we talk about company earning profits before interest, tax, and depreciation, does that equal the cash that the company actually earned in its bank account? The simple answer is no. The reason this happens is that a lot of the profits of the companies very often gets blocked in working capital. So knowing how much profit the company generates is not good enough. How much cash the company generates is actually a lot more crucial. And what you see on this slide is essentially the trend lines of two different companies in the pharmaceutical sector, the lighter line being Aurobindo Pharma and the darker line being Torrent Pharma. And what you can broadly see is that over time, Torrent Pharma has been far more successful in converting EBITDA, which is profits before interest, tax, and depreciation, into cash in the bank. Aurobindo has typically been converting cash or rather profits into cash at a much lower rate. Now, go back home or if you're on the net, just go to any website and look at what's the P multiple of Aurobindo, what's the P multiple of Torrent, and what it will show you is that the P multiple of Torrent is higher than that of Aurobindo. Does that make Aurobindo attractive? Does that make Aurobindo cheap? Our answer is no. The reason it is not is that because Aurobindo does not convert its reported profits into cash in the bank, Torrent does a far better job of that, and that is why it gets a much higher valuation. So this is the sort of value addition that my analyst team brings to the picture. Let's look at another example. Now, remember what I told you. The value of the company is the value of the cash that it generates over its lifetime. Now, think about a company like Sun TV, right? You all know it runs hugely successful business running primarily its Tamil channel, which used to be number one in the Tamil domain. And then, of course, it has sort of a top 3, top 4 position in the other 3 regional languages. Now, unfortunately for Sun, viewing habits are changing quite dramatically. People are moving away from the traditional TV channels towards OTT entertainment, the Netflix, the Z5s, and all of these. And even in the TV business, the traditional TV business, the sort of focus is shifting away from the low-cost family dramas, more towards celebrity-led, high-cost, reality-type TV shows. Now, if you look at that gray line for Sun TV, which is the P, you'll see how over time, and particularly in the last 2 years, there's been a dramatic derating of the company. Now, mind you, the company continues to generate cash, which is that darker line that you see going upwards. But now think about intrinsic value. Does that mean this company has a lot of value? It's throwing up a lot of cash? Our answer is no. And the reason the answer is no is that this company now faces the challenge of a limited terminal value. It is unlikely to continue generating this kind of cash over the rest of its lifespan. And in fact, it may have to aggressively invest to convert its business model from a traditional TV channel into a over-the-top offering like a Netflix or a Amazon Prime, or for that matter, they do have their own offering called Sun Next, but they will have to make significant investments. So when you look at that cheap P multiple for Sun TV, does that tell you it is value? The answer is no. And the answer is no simply because the remaining life of that company now looks to be challenged. It has what we would call low terminal value. And if you look around you, you will find lots of such companies. Think about a company like Coal India. They have a lot of coal. In fact, the amount of coal that they have at their current run rate, it would take them about 60 to 70 years to mine all of that. But ask yourself another question. Given the pollution norms that are coming in, given the fact that India is a signatory to the Paris 2020 agreement, which means we have to reduce our emissions from coal-based power plants, will all that coal ever get used in its entirety? The answer is increasingly looking to be no. Maybe the demand for coal actually starts to decline somewhere over the course of the next 10 years. So maybe they'll never get to mine all the coal that they actually have in the ground. Again, that's a case of low terminal value. Let me throw another name at you. This was once a blue chip company called Castrol. Some of you who drive two-wheelers would be familiar that you normally add a lubricant into the tank along with the petrol, and perhaps you used Castrol. But as you move towards electric vehicles, you don't need lubricants anymore. So again, it's a business which has a low terminal value, and that gets reflected in a lower P. So this is the point we're trying to make. When you interpret value as being cheap PE multiple, it leads you down the wrong path, because it is taking you towards businesses which have low terminal value but have very low intrinsic value, and you don't want to go there. So this is another example of the pitfalls of looking at cheap valuations. This is another example. Just focus on that straight blue line that trends upward, and those yellow sort of hills which again trend upwards. What we are doing here is that we are comparing the P ratios of two companies. One is Tata Consultancy Services, the other is HCL Tech. Now, both are actually very fine companies, but we just think that if you were to look merely at cheap PE multiples, it would pull you towards HCL Tech. Whereas the reality is Tata Consultancy Services has created a lot more value for investors like us than has TCL. The reason for that is that Tata Consultancy throws up a lot more free cash, which it can return to shareholders every year. In fact, they are now returning close to 90% of the profits that they generate every year to their shareholders through dividends and through buybacks. Now, when a company, remember that thing about intrinsic value I told you, it is the cash which can be returned to shareholders that matters. So this is a classic example. They're able to return a lot more cash to shareholders, and that is why it gets a much higher PE valuation. So if you look merely at PE valuation as an indicator of cheap, it would pull you towards HCL Tech. But really, the company which has created tremendous value over the last decade has been TCS and not HCL Tech. And HCL Tech has stayed cheap throughout this entire period. So again, there are many examples that I can give you over here, and you will see it across sectors. You look at the cement sector, you look at the valuation that a company like Shree Cement gets compared to the valuation, let's say, a company like Ambuja Cement gets, and you will see that there is a massive difference simply because one company throws up a lot more free cash than the other company. So again, I want to drive it back to that same point, that when you think of value investing as cheap PE multiples, it pulls you in the wrong direction. You always need to keep that framework of the cash that can be returned to shareholders over the remaining part of its life. That is what we think really means intrinsic value. Just two other quick examples here. Companies should be effectively run for the benefit of all shareholders, right? Which includes mutual funds who are minority shareholders in companies. Now, what do we have here? We have two large public sector companies, ONGC and Power Finance. Now, unfortunately, these companies have been used a little bit like a piggy bank by their majority owner, which is the government of India. ONGC does not receive the full price of oil because the government takes away a big part of that by way of royalties and taxes. And therefore, even in the best of years, they receive just less than about $45 for every barrel of oil that they sell, even when the price was as high as $100 a barrel. Further, when the government of India needed money 2 years ago, they made ONGC buy another company called HPCL at an extravagant price because that money was coming to them. And therefore, this was actually against the interests of minority shareholders like ourselves. And that is why you continuously see, because of these unfriendly actions of the company toward their minority shareholders, these stocks have completely derated. The price to book has dropped from over 4 times in 2014 to less than 1 time today. Does that make it value? My answer is, when you force companies to do arranged M&A transactions. It destroys value, and that is what is actually getting captured over here. This is one final example, a company called Imami. The dark line shows the fact that the promoter has been continuously pledging his shareholding in the company to promote certain real estate ventures and other businesses. And as the promoter's interest in those other businesses increased and the pledge against the shareholding kept going up, the market responded by continuously derating the company. And that EV to EBITDA, which is a measure of how you value the company, continuously kept coming down because investors worried about the fact that the promoter was losing interest in Imami, which was actually the main cash cow for the company. So again, this is a classic example. And again, nothing wrong with this company. In fact, some of our funds actually own the company and we bought it over the last 1 year. But we bought it because the promoter came out and said, look, I know what I've done is wrong. I'm going to correct it. I'll bring the pledge down. I'll sell a lot of my other businesses and bring that cash back and remove the pledge. And as he did that, that stock has, sort of doubled from its lows over the last 1 year. So of course, redemption is possible. But again, I'm just giving you a framework for understanding why cheap valuations does not mean you're getting something which is of value. Things happen for a reason, and that is why stocks are priced cheap. So I won't spend too much time on this. This is just a list of the various issues which drive you towards value traps. Those cheap valuations you look at are actually value traps. This is a whole list of them. Maybe in Q&A, if there's anything, I can come back to some of these points. But just in the interest of time, let me move on. Because the perspective I wanted to share with you, and I discussed this with Atul earlier today, is we just wanted to talk to you about how is it that we at UTI as an investment team, what do we bring to the table as professional investment managers, which gives us a perspective and a methodology which allows us to avoid these value traps. In fact, I would say a lot of investing is not about finding the companies which will make you the most money. All you need to do is have a process which ensures that you stay away from the companies which destroy value. The minute you do that, you're working with a much tighter set of companies, and the probability that some of those will turn out to be massive value creators has already gone up. And that is what the investment process brings to the table. This is the section I wanted to sort of leave you with some thoughts. Finally, we at UTI, strongly believe that investing is a process, and we bring a very talented set of individuals with a lot of experience, blended with youth, who come together to drive that investment process that enables us to do things like avoiding those value traps, thinking about value as intrinsic value and not getting stuck in this trap of cheap valuations. We call our investment process SCORE Alpha. SCORE is actually a sort of reconstruction, or it's an acronym created out of the two pillars which drive our investment process. Alpha is nothing but the outperformance that we deliver relative to the benchmark. And the reason we put it as part of the name of our process is that that is what the team is focused on, creating alpha for investors like yourself using our methodology, which we call SCORE. Any investment process has these three elements: strategies, which are the funds that you participate in; the process, which is how we standardize methodology; we identify good stocks, but equally important, avoid the poor stocks, and build consistency over time. It should not matter whether you come to invest with me today or 5 years later. The process is our compass, and therefore, while we will always need good people who sit in our team, it's the process which keeps us true in terms of finding our North Star with the compass at every point of time. We have a very experienced and talented team at UTI, up to 19 people today. And it's this team of people who are constantly analyzing companies, running it through all these parameters, and then sort of arriving at a decision of which are the companies we would like to invest. And then, of course, the fund managers play the role of determining which of those ideas actually flow into the investment team. So Atul made the point about do it yourself. The reason I put this slide with so many people is to give you the comfort and the knowledge that there is a lot of intellectual bandwidth which is going into managing these portfolios, doing the data crunching, the research, and delivering the kind of outcomes that we think would make you as investors happy. Finally, this is the last slide I just wanted to leave with you. Our method and our process focus on two critical pillars, what we call operating cash flow, because as I said earlier, profits are actually an opinion based on accounting principles. Cash is reality. So our process tends to focus more on cash rather than just looking at profits. Very simply, finally, we want to invest in companies where the return on capital is higher than the cost of capital, because if that is not the case, you can never make money. So this is like an eternal truth, but it's an eternal truth which we embed into our investment process. So I think I'll halt over here. This is essentially sum and substance of what I wanted to share with you, which is to say, value is nothing but intrinsic value. It does not mean cheap valuations. Cheap valuations actually camouflage many risks inherent in the business. They tell you nothing about the cash flow that the company generates. They tell you nothing about the return on capital that the business is able to earn. And these are the two pillars that drive long-term wealth creation. So I'll halt my presentation over there. I hope I was able to give you some insight into this whole idea of what is value, what are the parameters we look at, and how as a team we are able to combine and convert this into strong outcomes for our investors.
Thank you so much, Vetri. I mean, that was just a phenomenal class or lesson in investing in general and in the power of process. From a Scripbox perspective, this rings so true for us. We are completely obsessed with process. As you know, that we follow an algorithm method, not in terms of algorithm trading, but the way we select funds is completely process driven. We look at data, we back tested our models for a long time, and we just completely are sort of believers in the process of investing. Outcomes will happen automatically, and then that's been our experience, and we have our customers who we serve. So moving on from there, I think a few questions have come up, and we please do use the chat window to send us questions. One is about, given the whole turmoil around fixed deposit interest rates coming down, sort of volatility in the yield in fixed income products, what's your advice to investors? Sort of how do you manage the EQ or the feeling about nervousness in these categories? So what would your suggestion be around fixed income investments?
Okay, so let me put it this way, Atul. Of course, people keep talking about the falling interest rates. And unfortunately, this is a mental anchor. It's a mental anchor because we are anchored to those 9% and 8% interest rates. And I just want to remind people that when I started my career in 1992, one of the first investment opportunities that came along was a ICICI bond, which paid 18%. Right? So I just want everybody to remember that, look, there's been a secular decline in interest rates that has been going on for a long time. If I asked my uncle, God bless his soul, who was with me when I started my investing career or my working career, he felt 18% was just about a competent return. He didn't think it was particularly good. Now, I imagine he would feel deep shock at today's 5%. But I think we have to remember that over time, inflation has come down. For the first 10 years of my career, consumer price inflation on average was close to 9 to 10%. Today, we've moved to an environment where we are looking at average inflation based on the Monetary Policy Committee, targeting a 4 to 5% inflation range. And therefore, it is impossible for you to earn those same nominal returns. If you're not clear with what nominal returns means, nominal returns are the stated returns. You reduce inflation from that, and then you come down to what we call real returns. So I would argue that we are seeing nominal returns come down, but I don't think real returns have dropped as dramatically. In that era when we had 16% bonds of ICICI, we had inflation of 14%. So honestly, the real return was still only 2%. So I think this is more an adjustment process rather than something for us to really get agitated about. And the reality is, in a low interest rate and in a low inflation environment, you will have low interest rates. Look around the world. The US people are happy if they get 50 basis points on the money that they earn in a deposit with the bank, and they look at us enviously and say, "Wow, you guys get 6%. That's brilliant." But then we've got inflation at 4-5% average. So we do need that 5 to 6%. So I would say always remember one thing: the reason you invest is to protect yourself against inflation. Fixed income investments will give you some protection. Equities give you much better protection. Don't anchor to the nominal. As long as you're outperforming inflation, you're doing fine.
Thank you. That's really useful. And as we always say, if you had to choose between fixed deposits and debt funds or liquid funds, liquid funds are probably preferable for certain circumstances. They're liquid by their very nature. They tend to also have at times better tax efficiency. But we leave it at that. The other question, which is slightly off this, is now that international stocks and international funds are available to and are being more actively pursued by a number of investors. We ourselves at Scripbox have a basket of international funds available to our customers, which we recommend. Apart from that, we are going to launch direct equity through a partnership with another company soon. How would you suggest our customers think about that as a category as part of their portfolio? And how should they go about investing in international equity, international mutual funds as a process?
I think, once you sort of get onto this bandwagon, that the reason you're investing in equity is to invest in some of the finest companies which can create value for you as an investor, as a shareholder, through the mutual fund route, because that's what we are doing. We're sort of taking care of it on a professional basis for you. Then you have to ask yourself the question, why are you limiting yourself to your geographic borders? If the best company which makes the products and services that not just you want to buy, but millions of people across the world want to buy, then why not have investments in those companies as well? There's a lot of data on this, Atul, but investors across the world suffer from what we call a home country bias. They know their own country well, with both its positives and its warts. They know the companies as well, and therefore they feel a bias towards investing in their home country. But I genuinely believe that should not be the case. There is a case for diversifying your investments across multiple geographies from 2 points of view. One is it provides you diversification. It allows you to buy some of the best companies in the world. And that diversification phrase is very, very important, right? Because, what if for a variety of reasons, your country does not do well for the next 5 years or 10 years? The diversification gives you certain benefits because it exposes you to other geographies, other companies. Maybe they play in a more global market and they don't get affected as badly. So I think both of these are very good reasons for investors to consider overseas investments in international funds. There's also a bit of a currency hedge which is involved there, and that's sort of the icing on the cake.
Thanks, Vetri. So from our perspective, in our core wealth hedge portfolio, we do advise customers to have a certain percentage of their portfolio in international equity, either index funds or direct equity.
Well, I have them as well, so I'm happy to tell people that they should do the same.
All right. The more standard questions, right? You talked about the traps in investing while you're directly investing in equity, looking at companies. What would you advise customers in a similar way who are actually investing only in mutual funds, right? So I'm not really investing directly into equity. So whereas at Scripbox, we obviously have a basket of funds, but there are customers who choose their own funds. And the lead-on question from there is the trend which we have seen recently of the Robinhood example in the US, and we've heard that more than 4 million demat accounts got opened during the lockdown. That basically people are doing day trading quite comparatively. So both, if you're a mutual fund investor, how do you avoid value traps? And similarly, on a related question, what are your thoughts around these people who are And our fear is a lot of people will burn their fingers. Our view, our house view at Scriptbox is that the Robin Hood thing is a bad phenomena. It just gives a bad name to the category, and people burn their fingers in equity themselves and then hold that against mutual funds. So, just what has been your experience in this complex question?
So I speak here from experience, Atul, because just like you have a young startup which is onboarding people into the equity markets today through the mutual fund route, I was part of a startup called Sharekhan, which is still around. It's now part of BNP in 1998, 2001. And it was our dream at that point of time to onboard people into direct equities. But I must say that there are significant challenges with that, simply because do people genuinely have the time and effort that a professional team is able to put together to be able to analyze, course correct, and is that really their primary vocation? Unfortunately, during the heydays of day trading in 98, 2000, people thought that day trading was a income generating tool, right? You could trade every day and generate income. I would argue that people's time and effort is best spent in their core competence, generating the income for themselves. And what is then saved is which you want to direct towards the market for long term investment. If you look at the market as a source of regular income, uh, believe you me, I have seen more than enough disappointment of a whole generation of day traders in 98, 2001, who I would argue perhaps have never recovered from the shock of what happened there. So, I would think day trading is honestly not everybody's cup of tea. I'm yet to meet anybody who became a millionaire by doing day trading. Of course, there are sophisticated hedge funds, but I wouldn't call them day traders. They're actually fairly robust risk management and trading systems that they use, and they've created a lot of wealth. But I'm yet to see the day trader who actually retired rich and young. Uh, uh, I haven't met them as yet. Uh, just going on to your earlier question on mutual funds, really the point that I would like to emphasize to people is what I said in my opening comments. All of us would love to have what I would call a all-weather strategy, right? But the reality is that once you pick a certain style and type of investing, there will be market seasons which do not favor that particular style. And therefore, it is very important as investors to recognize two things. No fashion stays in style forever. There will be seasons when your fashion works, there will be seasons when your fashion does not work. You need to have either your own process or work with a Scriptbox or somebody who's doing that advisory role for you, who has a toolkit, who can tell you whether the fund is doing poorly because they have actually changed direction, or whether they are doing poorly because the style does not match the market mood at this point of time. Now, at UTI, actually, we publish what we call a ready reckoner, which is actually like a data table. And the way I describe it to people is that this is like your health report, right? So we are publishing everything about the portfolio, including its pulse rate, the heart rate, the fat level, etc., etc. So it's a whole page full of data. And the reason we do this is that what we are saying is that if you track our data over time, anytime you see the data suddenly spike out of the range, you know that we are now doing something different compared to what we used to do.
Okay.
If you are doing exactly what we told you we would be doing and we are not performing, then it's a season problem. We are doing what we said we would, but the season is not matching. So that's a great way, I think, for people to get around this understanding of why is the fund doing poorly. Is it because they are doing something wrong? Have they changed their approach? Or are they continuing to do what they said they would do and the season doesn't match? And I'm sure, people like you and advisors need to build those models to be able to track it. We've, of course, gone a step further and said, here's our data set. It's visible to you every month, so you can monitor those health parameters, by yourself.
So similar to what you were talking about in value investing, obviously companies have a certain direction, and the reason you transact or you trade is that some predictions don't go the way you thought, or the company changes direction. And so, how often would you? So, in our case, we do a annual portfolio review for our customers or of our recommended basket, And we say, okay, like you said, some fund managers have changed, the strategies have changed, the performance has changed, and we recommend some changes to our customers to get it in and out. Similarly, we do a quarterly sort of portfolio scan for our customers and tell them, hey, because you have to do continuous monitoring. Whereas some people believe that sort of you buy it and keep it for the next 7 years. Similarly, I mean, what would be your views on this? Because people think equity investing is long term. And so the question you get asked is, one side you're telling us long term investing is 5 years, 7 years, leave it. The other side you're saying, no, keep balancing your portfolio again. And how do we solve this? Because we believe that regular rebalancing is important because things change. What are your thoughts on that, Vetri?
So let me flip that around, Atul, and just talk about how we do it as fund managers. So I'm now talking about my portfolios. And I think one of the things at UTI that we really focus on is when we are asking our investors to think long term. Now, long term doesn't mean that you don't do anything, but are you really reflecting that long term approach in the way that you run the portfolios? And I run a team which actually has a very diverse set of individuals. Somebody practices deep value, somebody practices out and out growth. Personally, I'm more in the intrinsic value, somewhere in the middle. And then there's another colleague of mine, she's more in the GARP territory. But the point I'm trying to make here is that we look at what we call portfolio turnover ratio, which means how much of our portfolio is changing every year, right? And we calculate that number every month. Now, I have 2 fund managers in my team who I think completely blow the lights out with their inactivity. Their portfolio turnover ratio for now 7 years has averaged between 12% to 18% a year.
Wow.
Right? Which means they're not turning their portfolio over more than 12 to 18%, which means the whole portfolio turns over only once every sort of 7 to 8 years. Right? So they're really bringing long-term approach. Compared to them, I look more active because I'm at about 25%. But the point I would really make is this. You cannot target 0. Neither should you be targeting 100 and any number above that. The mean is perhaps somewhere in between these two, because there will be circumstances which will cause you to review stocks that you own. Companies will stumble. Managements will disappoint. Managements may turn out to be not quite what you believe them to be. At that point, you will have to cut your losses and move on to something else. But at the same time, you must always be prepared to navigate a storm in your portfolio. People ask me the question, we've got some of the best performing funds over the last 1 year, even though I say that myself. My portfolio turnover ratio over the last 1 year is still 12% to 25%. True. Right? So we got a once in a 100-year pandemic, but we didn't have to respond to it. And you know why we didn't have to respond to it? Because we had a process. I always say be prepared, because you can't predict what the future will bring along. But if you're prepared, you can navigate the toughest storm that you will come across. Somebody else said this much before me. Ships are safe in the harbor. That is not what they are designed for, right? But you will have to course correct. So I think it's a fine balance. There's no simple way to say hold it for 7 years. That is the only way, or keep churning it every 6 months. There is a fine balance where you'll have to review. Final concluding point. Internally, we follow what we call what are your reasons for selling, right? And we have about 3 core reasons that we practice. So you must have that. Just as there are reasons to buy, you must have those reasons to sell. And when they cause you to transact, of course, you must transact. But make sure the impact cost is something you can manage or will be bearable. More important in your case, Atul, because your investors have a tax impact. I don't have a tax impact.
Oh, absolutely. So, I mean, unlike most other online platforms, we have a tax optimized
right.
So we optimize for tax loads, exit loads. So typically what we say is if you've got a portfolio of 100, we'll review it every quarter, maybe 2%, 5%, where we feel are they very small holding. It's because over diversification is also not great. And we see this actually often when people migrate their portfolios from a different provider to us. In a 10 lakh portfolio, you will find 60 funds, which just blows our mind out. And we say, what are you really up to, right? So we try to bring in less diversification. Churn is obviously to basically, the idea is can you keep getting them to get better? Because obviously you don't want people to change their entire 60 overnight. It'll take a 6 8-quarter period to do it in a systematic manner. Last question. So before we are out of time, how can the term value be misinterpreted in the context of mutual funds?
So the reason for today's presentation was actually a blog written by one of my colleagues. He's actually my co-manager on what we call UTI Value Opportunities Fund, and he was sort of in a very somber mood one day, where he said, I grew up in a culture where I always thought value for money was the most powerful idea. And suddenly I find that when I tell people I run UTI Value Opportunities, they say, oh, no, we don't like value investing. So, which is where this thing came, that why has value suddenly become, this sort of bad word that people want to run from. As I said, I think value is important. Value is important for that very simple principle in life. Value for money, you want to buy something for less than it is worth, which brings in that concept of margin of safety, because you don't know what the future might hold. So we believe that concept of value is core to the investing premise. However, one should never understand value to mean cheap valuations. In conclusion, because we've been talking stocks here, let me remind you that once upon a time, there was this company called MTNL, Mahanagar Telephone Nigam Limited, right? It was the monopoly government-owned telecom provider in Delhi and Bombay, right? It used to trade, at a P multiple of 5 and 6, and people said, oh, it's so cheap, how come? And then one fine day, you realize that all their best customers have moved to the private sector. People are using their mobile phones more and more. And then this company actually reaches a situation where the revenue is now less than the cost of their employees. They can't even pay their wage bill. So this is where, again, I want to just reiterate, when you say value, you have to mean the right thing. If value means cheap valuations, you are asking for trouble. You need to think about that concept of intrinsic value. That's what we practice.
Thank you so much, Vetri. It's been an absolute privilege and a pleasure to have you with us. We look forward to having you back again with us sometime soon. And on behalf of everybody who's listened in, and thank you very much. If you've not answered your questions directly, the team is noting them down. We will reach out to you and answer them. I hope all of you enjoyed it, enjoyed the session. We have a feedback available to you. So thank you once again, Vetri. It's been a pleasure to reconnect. And I've learned a lot, and I hope the audience too has. Have a lovely weekend, and happy Diwali in advance to everybody listening in, and happy Diwali to you, Vetri.
Sure. Yeah, thank you, Atul. Thanks everybody for logging in, and happy Diwali, and stay safe, everybody. Thank you.
Thank you. Cheers. Thank you very much.
Cheers.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.